A strong slew of corporate earnings driving the S&P 500 to its best week since November last week. According to FactSet, 46% of companies have reported Q1 earnings so far, 77% of them beating profit expectations. But overall, the S&P 500 has taken a breather in April, off about 2% over the past month as investors reprice rate cut expectations for the year, and several Wall Street strategists say high rates remain a key headwind for stocks. Yahoo Finance's Josh Schafer joins us at the desk with more. Hey, Josh.
Yeah, Brad. So when you take a look at sort of the market action over the past couple of weeks here, I think there are some things you'd see in earnings that make you think that the index might be higher than it currently is. I'm thinking of perhaps the net profit margin we've seen from the S&P 500 this year coming in at 11.5%. That's above what we saw last quarter. You take a look at just how earnings have come in general. The index itself is now pacing for higher earnings than what strategists thought 3 weeks ago. So overall, things have inflected better, but we haven't really seen it reflected in stock prices. So sort of what is the key catalyst behind that, right? And it seems to be higher rates. And so several Wall Street strategists out today highlighting how higher rates are impacting stocks. Michael Kantrowitz said that at this point, it's really hard to see equities going higher without rates going down. That's the stance from over at Piper Sandler. And I think it really just stands out to me because we've seen the 10-year move up about 40 basis points in the last month. The S&P 500 is down almost 3% in that time. It has been a very clear back and forth as it was last year, which is, okay, stocks are down today. What's our catalyst there? It's yields up, right? And so when you have yields up, we've had stocks down, it's been pretty easy to sort of watch that correlation. And that's also something you've seen play out when you look at something like the 2-year, right? The 2-year yield last year when we hit 5%, which we just got to last week, that's when stocks started to bottom. And that's where we were at over the past week. You can see it in the chart there. The S&P 500 starts to turn negative as the 2-year yield hits 5%. It's a pretty linear thing to look at here and something that a lot of people on the street are highlighting.
You know, it's a bit surprising because you mentioned the fact that we are getting better than expected margins, right? Especially when you compare it on a year-over-year basis. You're also talking about that profit growth outlook, which up until this point has been pretty robust. Obviously, it could change once we get more earnings results here this week. So you could make the argument that that is likely going to support here. Obviously, the market's trending higher despite what the Fed does. But I think the question is to what degree does that movement or the movement higher that we are going to see, and how much of that excitement or how much of that positivity here has already been priced into the market up until this point?
Definitely. I mean, you're trading at, well, we'll get into the valuation discussion here, right? You're trading at a valuation that is very rich. You're talking about maybe 20 times earnings right now. And I saw Kevin Gordon over at Charles Schwab highlighted this morning when the last time we were at 5 years on the, or 5% on the 2-year, we were trading at like 14 times earnings. And so when you're, that would be for the 10-year, going back to 2007. And so really the market right now is very richly valued, which is why people are saying the one thing that can maybe push us a little bit higher is earnings, but that's normally in the large cap stocks that we're talking about, not necessarily when you go down the cap spectrum. But that is the call still, is earnings can help perhaps individual stock moves, right? It's not to say that it won't help at all, but for us to have some sort of broadening rally where everything gets a bid, it's a little hard to reason that that's going to happen when your 10-year is at 4.6% and only creeping higher.